So next up is our finance panel, who will discuss recent shifts in private investment, the funding avenues available for Irish SMEs, and what's needed to get investment ready. They are Helen Cahill, the co-founder and CEO of Financefair, who has facilitated over $2 billion in funding for scaling businesses. Mark Flood, who co-founded Renatus, a private equity firm investing in ambitious Irish and UK companies. And Alan O'Dea, a director at Beachbrook Capital, responsible for investments across Ireland, the UK, and Northern Europe. Brendan Lenihan, managing director of Navigo Consulting, joins our panel today as our host and facilitator. Please join me in welcoming them all.
Thanks, Siobhan, and thanks to Paul for the invitation. And just to echo Paul's comments about John Mullins, he'll be sadly missed. But just to link to John Finn's presentation, I guess there's a great alleged Chinese proverb, which is, it's better to wear slippers than to try to carpet the world. So in many ways, you can look at everything that's going on in the world, and John has explained it really, really well, as he always does, at the level of your individual firm. What do you do in terms of the economic reality? What do you do in terms of funding? And when I started my career back in the early 90s, there were not a lot of options, actually, to be fair, in terms of how you funded the world. And in many ways, people saw cash and money as the destination. Now people think of it as a raw material. You got to source it well, you got to buy it well, it's got to come in the right quality, and it's got to be productive for you, because it's a really important raw material to get you to your destination. So I'm really honoured to be joined this morning by three folks here who have a lot to say about alternative ways of funding your business, ways that wouldn't have existed actually in the early 90s, it's fair to say, or certainly not very prominent in Ireland. And I'm keen to just probe with them what it might mean for businesses like your own. But one question to start to each of them, which is, are you open for business? I mean, there have been times in the cycle when financiers and people who control money have just decided to shut up shop. The world is too volatile, so much going on, we're just not giving out money. So for each of these three representatives on the panel of this sector, I just want to start with that quick question. Are you open for business right now with everything that's going on in the world? Helen?
I just received an email before I stood up from Rob Horgan, who I met yesterday from Velo Coffee in Cork Chamber, and he said, look, Helen, best of luck in the panel. Just start off by saying to everybody, we're here to give you money. So Financefair was born out of the turbulence and the dysfunctionality after the global financial crisis. So we're used to, as John alluded to, traditional providers and banks tend to go risk off when there's a lot of uncertainty and volatility. We have a very deep lending pool, funding pool, and also our model is all based around receivables, which themselves are slightly uncorrelated. They don't behave the same way. So our funding is deep, it's very sticky, and we're very much here.
That's a yes, yeah. Alan,
a big yes.
How about you?
Yeah, I think, look, the last week obviously has been last 2 weeks incredibly volatile. Markets are swinging up and down by 5 or 6% every day, but I think the one thing we are certain about is that ultimately they will normalise, they will rebound, because ultimately it's driven by human behaviour. And I think the four key words that are lethal in financial markets are different, because it's not. Ultimately, you know, people will navigate the situation, address the risks. And I know John obviously mentioned black swan events. I think COVID absolutely counts as a black swan event. And what the Irish Entrepreneurial Network demonstrated over the last 5 years is their ability to be resilient, adaptive, navigate the new situation. And, you know, we've been in operation since 2008. So we've experienced multiple market disruptive events. But throughout that period, we've remained consistently delivering capital, factoring in obviously each unique risk with each market cycle. But I think from an investor perspective, you do need to have that long-term view. You do need to be consistent.
Okay, that's a yes. And Mark?
Yeah, very much open for business. As they say, a boat is safe at harbour, but that's not what a boat is supposed to do. So we have a fund that we need to deploy, and we're very open. We had a 10 million fund, 3 investments, 40 million, 6 investments, and we have a 60 million fund. But what I would say is that, you know, there are questions at investment committee level to like 2 big questions. Anything on the food and pharma food chain, what is the effect in an extreme situation? If, you know, there's great companies, when you think of what's around Little Island and Ballybrit and Galway, different places that are on that food chain, and we have been involved in a few, but that is a big question. And the other question is, if we are at the top of the cycle, what did this kind of business look like post global financial crisis? And
Okay.
so we're open but careful.
Yeah. Yes, but yes, and. Okay, I'm going to ask the guys in a minute to just describe what it is they do and give you 1 or 2 practical examples of how that's worked for companies. But actually, before that, when we get on a call, we just put together, and Helen very kindly put together for us, 1 slide, which is about the funding journey. If you can pull it up here, and we can, the life cycle of the funding journey. I have it here, Helen, if you want to speak to it. And we might talk about that, and then I'll ask the guys where they fit in and what it is they do with some practical examples. So, Helen, do you want to chat us through this?
Yeah, I mean, this isn't reflective of everybody's funding journey in the audience, I'm sure. But a typical funding journey starts off with somebody having an idea, and you know, they go and get funding for that. And we know in Ireland there's a huge ecosystem, meetups, accelerators. Enterprise Ireland are a driving force, whether it's their competitive startup fund, their HPSU, the Leos are very good. So there's a lot there. However, what we're seeing is that once companies have kind of, that well has dried up, that there then is a significant funding gap when it comes to the next stage of their growth. And I suppose that's where we play. And if a company has revenue and is growing revenues, our model unlocks growth funding from their revenues. And we serve companies at different stages of their growth. So we'd advance up to 250 for some stage, up to 750, and then others will advance up from 750 to 3 million. And companies have journeyed with us. So we don't provide term funding, but we provide growth funding. And there are companies that we've been funding for the last 5-8 years, all around receivables.
Okay. Great, all around receivables and working capital, essentially. Yeah.
Exactly.
Yeah, and Alan, where do you fit on this slide to the extent you can categorise yourself?
Yeah, so if you look at I suppose after the kind of Series A, B, C, and D, we're kind of at that stage where companies reached a level of profitability. Our loans typically start at kind of 4 to 5 million and can go anywhere up to 20 to 30 million. So businesses are usually, their product is commercialised. They're at that stage where they're now seeking capital. We kind of described as, I suppose, transformative capital, because you're using it as a catalyst for that next leg of growth. You're typically going to be generating EBITDA in the range of kind of 1.5, 2 million upwards. And that's kind of the area we fit in terms of sectors. We're quite agnostic. It is really much focused on the growth opportunity. We're not restrictive in terms of how it can be used, whether it could be for organic growth, whether that's boots on the ground, investment in CapEx, or inorganic if you're making an acquisition. Routinely what we see is shareholders in a business realigning the cap table, and that ultimately does provide a catalyst for future growth. But one important point, and it's important for companies to understand, is I suppose you shouldn't view us as being mutually exclusive either. We support companies, private equity-backed companies. We have one company where we actually refinanced out Financefair. And we have situations where we're working alongside them as well. So it is quite beneficial for companies to know that there is multiple options available. But in terms of the specific parameters, that's where Beachbrook fits in.
Okay, thanks, Helen. And Mark, where are you? What's your sweet spot, I guess?
We're 2 from the bottom, PE, private equity. We are equity, so we take shares of businesses. It's not a coupon on our money. So we do, of 9 of our current businesses, Helen and Financefair back 2. So we coexist together there, and Alan and David and Beachbrook guys, we've collaborated a lot in a sense over back, so we'll be disappointed if we don't do something over coming years together. But we are equity. There's probably 3 situations where equity plays a part. One is where somebody is exiting their shareholding. The second is where somebody wants to chip off some, we call it monetized success, other people call it de-risk, but they've been on a journey, and a lot of our transactions have been where people had offers from trade, and we decided to say, well, how about you take half off and we'll roll half and we'll go on a journey. And it's just been amazing for the psychology for people as well, because they get to kind of bear the fruits of success, and then they're probably a little bit more going for it when they've got the money in the personal account, and they can really go for the growth. And the third is then when there's money needed for, in particular, acquisitions or capital investment within it. So there are 3 scenarios where equity makes sense.
And sticking with that, Mark, just do you have 1 or 2 practical examples, to the extent you can share with us, of how that has worked for businesses you've helped?
Yeah, probably CRS is a good case study. It was 2 brothers took over their dad's business, and they were in a lot of different facets of refrigeration, but they really focused in on taking a ship container and turning it into a modular refrigeration or freezing unit and leasing it to food and pharma. And that business, they were on the cusp of selling it, and they decided to sell 40%, and it trebled in 4 years. And we brought a lot of things to the table to them. We brought a really good finance structure, one of the traditional banks that allowed them scale, where before they were always kind of pulling in for petrol every 10 miles. So it just capitalised them for proper growth and got good people around, grew into the UK and Europe, and they've actually chipped off half again and gone with the new owners. So they've really monetized that along the way, and they just are so grateful for not selling 5 years ago when they could have sold 100%. So really, what we bring along with equity is experience around and really get that strategy and org chart right, where we bring in the right people. But it's all about preserving the DNA of the business and bringing in some growth levers and getting the balance.
You're bringing some growth DNA in with you as well, I guess, and a raw material. We okay with that?
Yeah.
Alan, some examples of where you've helped businesses?
Yeah, so maybe I'll describe briefly the structure of our loans. They're non-amortizing, so you only service the interest, bullet repayment, usually after 5 or 6 years. And the reason we structure our loans like that is we want to support the growth in a business. We'd rather the cash flow is being reinvested rather than paying down the principal. But in contrast then, where that works, I suppose, also to the benefit of the company, is during a period of volatility. One company we supported back in 2019, market fell away during COVID, but having that headroom with their cash flows allowed them to manage the crisis quite effectively, and they came out the other side, and the business has been performing extremely well since. Another business that we supported, we initially provided a loan back in 2018. It was an industrial engineering business that was to support an acquisition. And we stay close to the companies that we support. We're not obviously as close as private equity. We're not involved in the operational decision making or anything like that. But we receive monthly management information. We speak to the management teams regularly. And that company went on a journey, a buy and build journey, and needed quick decisions around acquisitions. And because we remained close to the company throughout that life, we were able to provide them the capital relatively quick and enabled them to make those acquisitions. And ultimately, at the end, we were refinanced out by a conventional banking source. And back to my earlier point, we don't view ourselves as mutually exclusive. Everybody has a role to play within the funding ecosystem. And that company is a prime example of where we fit in on its growth journey, buy and build, and then ultimately being refinanced out when it reached a certain level of stability by a conventional banking source. So it's really playing in that area where you may not have a lot of collateral to mortgage, or it is true cash flow lending, and you are ultimately backing the owners and the managers of the business, because I think, look, all of us here are involved in SME investing, and if you expect the performance over a 5-year period to go in a diagonal straight line up and to the right of a graph, you're probably in the wrong business. So you are backing that management team not only to deliver on the growth, but to navigate a crisis as well that will inevitably happen throughout the period of that investment.
Well done. And Helen, some good war
yeah,
stories
we
here.
fund, I should say that we're sector agnostic and we fund across all sectors. But there are some sectors, sadly, that are completely and utterly ignored. Technology would be one, e-commerce, SaaS, and particularly companies where they don't have tangible assets. So that's important to note. We're sector agnostic. We are receivables based. And to John's point, we don't automate our decision makings, but we do leverage technology. So we're able to reach in and see the sources of truth. It's very important that the audience understands how valuable that is in order for us to be able to advance and lend money where others can't, give it quickly and give more. An example of one local to us, and we met them yesterday, Aidan and Hilary from Autonomy. They're building, they've 400 people now. They are building and scaling a fully remote, tech-enabled CX company, where companies like Aura, for example, are engaging them to manage their business and an outserved, a modern version of an old call center. And the problem we're solving is that if you look at their balance sheet and where they are, it mightn't be bankable. We can fund their growth, and we can fund it where they have particular concentration within their customer mix, as all companies do. So again, because our funding is different, it looks through a different lens, and it's all about the quality of the receivables. We're able to walk that path with them. Another example would be the likes of Tom Cotter in Ocean Ore, locally here in Cork as well, in the sustainable luxury apparel business, and has really strong recurring revenue with the resorts and the suppliers or the customers that he supplies into. And we have a mechanism for leveraging that strong, predictable recurring revenue and funding their growth. And it may well be that at a point in time they need something different. They need an Alan or they need a Mark, and we might be taken off the pitch, but then we might be brought back onto the pitch to work alongside a senior debt funder or private equity or a VC. Why? We're the growth catalyst. We drive growth.
Okay, that's great. And to say the obvious, there are other sources of advice here as well. So Paul and his colleagues, for example, will advise on that growth journey. To kind of declare an interest here, I sit on the investment committee in Enterprise Ireland as part of one of my non-executive roles. So EI are a great resource to you if you're an EI client. They will also, this is a habitat where Ireland is a village. Everybody knows everybody else, and often people with that knowledge can provide you with some good leads in terms of sources of finance to think about. Now, I just want to get on to the practical question, I guess, of if there's somebody out here who wants to come and interact with you as organizations and benefit from some of the services and products that you have, what advice would you give them in terms of just preparing to interact with you, to get ready to deal with something that might be a novel source of finance? If my business already has been financed by my own cash flow, my own retained earnings, it's a terrific business, I maybe have a bank loan on a premises, but that's about it in terms of sophistication. How should I be mentally prepared and practically prepared before I come and engage with you? Mark, or Alan, sorry, I'm going to start with Alan on this particular one. What advice, practical advice, would you give me about starting to talk to you?
In simple terms, get advice, right? And the reason I say that is because if you're talking about an investment from Beachbrook or Renatus or whoever it might be, you're talking in the millions. At least with us, it's 5 million, which is a material sum for an investment into an SME, and it's probably the first time that they're taking on board that level of investment. John referenced it earlier about information flow, and that is absolutely critical. We can move quickly if the information is available, but getting that information together is time consuming. It will take away from your daily operation, running the daily operations of the business, and that's something that ultimately you don't want the business to suffer for 3 or 4 months when you're running a transaction to bring in funding. So having proper advice on board, helping you prepare that information, it will pay for itself. But importantly as well, the market has evolved a lot over the last kind of 5 to 6 years. It's a lot more educated now in the alternative sources of capital. And from a borrower perspective, having that advice on board, you're going to be presented with a range of options. You may have only thought that there might be, two options available, but you're now dealing with somebody who's able to bring you a range of options, who's able to negotiate on your behalf, and ultimately find you the most optimal solution for your business. So it really is that simple. If you are talking about taking on board, 4 or 5 million plus of investment, having advice on board, it pays for itself 10 times over, in my opinion.
Sure. Mark, how do I get myself fit and ready to interact with you?
Yeah, I'd agree with everything Alan says and what you say. That look, a good advisor will help you matchmake. Who's like, take us, we'll do 2 deals a year. So if we, we're not going to. So an advisor will think what suits these different type of equity houses. There's probably a dozen brass plate equity houses around, and you have the pillar banks. They'll know what'll get there. So a good advisor will do the matchmaking. There's 2 parts to getting ready. One is getting to, call it heads of terms, and the second is getting from heads of terms to an executed deal. So if you take those 2 work streams, getting to heads of terms is your story. Like, what will someone buy the story? So we always say it's a 3-page PDF. 1 page is your last 3 years. What have you done? Second page is your next 3 years, which encapsulates your strategy. And the third is your org chart, your people. Getting that right is just so crucial, because that then will land on someone's desk and say, yeah, oh God, they've delivered well the last 3 years. I like that plan. They're going to double. And whoa, yeah, they're good people to do it. So that sounds easy, but it's so hard to get the right people in the right places. And that involves people at that point in time in the org chart who will sit in front of someone and say, I'm committed to this for the next 5 years. You can have someone who's delivered the last 3 years' numbers, but they're looking at the door, and people will spot that on the way in. So that's the 3-page to get to heads of terms. But then from, say, that gets someone to say, I'd like to do a deal with you at this basis and this. But then from heads of terms to execution, and this is where your Paul and your advisors come in. It's just having your house in order, like having everything in order, your whole, if it's leases, if it's agreements, if it's everything that'll be asked in a due diligence, and you need someone looking around the corner, and you need to be preparing for that, years in advance with a good advisor and a good CFO. But they're the two facets of it. Yeah,
and that was interesting. We were chatting earlier on about how the fact that you can't do much about the last 3 years, but you can tell the story. You can tell a story about the business you're in, the customers you have, but getting the strategy right for the next 3 years and getting the org chart right, they're just gold, really, aren't they? Helen, what's your advice?
I agree with the guys. I mean, we fund a lot of Enterprise Ireland companies, and we are kind of, the market is not short of ambition, companies that want to scale. My observation would be that there's probably an education gap around the range of choices that are available, number one. Number two, I think that people need to be much more selfish about what they have and being forensic. So that means, do I have a strong management team? Shine a light on it. Do I have a strong cap table? Shine a light on it. Who are my customers? Because certainly Financefair, we take a very forward-looking view in terms of our underwriting decisions. How am I going to grow my business? What business am I going to win? And the quality of dare I say again, the quality of those customers and those receivables, and being able to set that out clearly, along with, in our underwriting model, we attach huge importance to strong financial control. It's part of our scoring system. And when we engage with customers, we actually ingest information via technology, open banking and accounting. Having that information in order, and enables us to make really fast decisions, to deliver solutions that are aligned to the growth that you're talking about at your own board tables. So I think that's being very selfish, really, about putting your best foot forward.
Yeah, I remember, Paul, you would remember back in the day when some of us were learning the ropes, we used to study Peter Drucker, who invented all these things, cost centers, profit centers, investment centers. And actually, I read recently, Peter Drucker said one thing, he said, I always regret inventing the term profit center, because there's only one profit center in the business, a customer whose check doesn't bounce. That's it. That is your profit center, actually, and the start and end of the business, the story of a lot of businesses, it is about its customers. You either serve them profitably or you don't. I just want to pick up and ask your views, actually, on one thing. John Finn made a really impressive presentation, but he gave numbers around the idea that we're seeing the effect still of the financial crisis in Ireland. Those of us who lived through it, we still have the scars on our back in lots of different ways. And he said, there's a big chance we're underinvested and we're undergeared, really, essentially. And the non-bank sector, and I guess you're kind of all in that broad category, maybe some more than others, is going to grow because we are underinvested and we have a lack of competition in banking. So what's your view on all of that? Are we underinvested, undergeared as a business sector in Ireland at the moment?
I can just give an example through the lens of Beachbrook, I guess, since I suppose we made our first investment in the Irish market in 2018, and just a few anecdotal points, but at the time, I suppose getting out there, building our network, letting the market, educating the market about ourselves, there wasn't a lot of education about alternative credit as a source of capital, and I suppose when you're talking to the various advisors, there was a corporate finance head, and that was it, and they were responsible for M&A, for raising equity, raising debt. But what we've seen since 2008 and over the last number of years in particular is that a lot of the advisory network now in Ireland are building out dedicated debt advisory positions, which is reflective of the market. And I think while there is still a funding gap, I do believe that it has closed significantly over the last number of years. And that's probably been led by private equity. It was only a matter of time really before international private equity firms started coming to the Irish market, realising the potential of businesses here. Mark obviously has been doing it since 2013, I think. Yeah. But with that then private credit flows with private equity. So the market is maturing. There's still a lot of opportunities, but I think from a borrower perspective and companies in general, there is a lot more education out there now, and they're getting more comfortable with alternative credit as a source.
Yeah, so you're also endorsing what Helen is saying about that education gap, that information gap about what's out there, and how applicable it can be to businesses of any kind of substantial scale at all. Mark, what do you think? Are we, as an equity guy, do you think we're undergeared?
I think we've met 2,000 companies since we started. I couldn't pinpoint, we absolutely love businesses and meet lots and lots and lots. I couldn't pinpoint that business that's kind of so conservative they're not growing. When you look at the M&A deals, every year we've been reporting them in newsletter, they're growing. And I think there's a lot of, so I couldn't pinpoint that business over there that if they got another turn of debt that they could be growing so faster. But there's also a dynamic where we have a big shift to services, and I think Ireland is really well positioned in the shift to services. If you think of, you can already see the spillover of the alumni from, take the old days of the digital in Galway, the GPA, that we can see it in tech. You can see it in a lot of tech, and you can see it in a lot of services. So services don't necessarily, a lot of businesses that we look at, the constraint isn't the capital structure, it's the people and operational. We've one or two businesses that could borrow probably 3 times, but they operationally couldn't deal with the doing another 4 acquisitions a year. So I think the constraint is less capital because there's so many variations of it, and it's more people in cases. So I accept what John says. It sticks out as a thing, but I don't see it in front of me.
Okay. I want to pick up any questions you have in a few moments, but I am just going to ask the panel first, so think of some really good questions. John also talked obviously about what's going on in the US and the idea that I think encapsulated in another, I think it's a Dutch proverb now, the Dutch have a proverb which says, trust arrives on foot and leaves on horseback. So you can spend 20 years building up trust, but as soon as you start to denigrate it, it just gallops away from you. What's your read on what's happening in the world now, particularly in the US, and where it's all going to end? Before I go to the audience for some pertinent questions. Anybody want to take that up? Any brave enough to take up?
I suppose we've 12 investments, 3 divested. Of the 9, 1 has a headwind and 1 has a tailwind, and the other 7 all have secondary exposure, which can't be underestimated at this stage. But that's the one, just to give you a dipstick of our world. Renatus, we do car license plates, and we've 10 states in the US we've won, but the actual material for the car license plates, which ultimately goes into correctional industries, the prisons, that comes from China. So like we've a relatively modest margin, and we're being forced to it. It's when you take the original tariffs, it's getting up to 130% when it's all loaded in. Like that's just unsustainable. So I don't know. Like, what do we do? Well, we're probably going to trade it for a month or two and see what happens. But you have to think it's unsustainable. And then the one that has the tailwind is a business that does construction tech into semiconductor and pharma, and we've set up base in the US, EIDA, IDA, and you have to think that there's going to be a lot more built. You hear Nvidia saying that that's where they want their chips built is the US. So one has a tailwind, one has a headwind, the rest have secondary exposure. And but it just seems too bad to be true that the Chinese thing can prevail.
Yeah, so in many cases, lots of Irish businesses have just secondary exposure, so there's a lot of that. And I mean, I heard someone recently say, you know, a 10% tariff, it's a pricing discussion. At 25% tariff, you're reorganizing your supply chain big time. At 50% tariff, you're dead. And at 150% tariff, you're still dead. It doesn't really matter where you go after 50%, really. Your margin is gone, essentially. Any other thoughts on the way the world is at the moment, guys?
I'd only add, without repeating what I said earlier, but like you can't make any material decisions now based on what's happening over the last 2 weeks, because, as John made the point earlier, his slides changed numerous times in the last week, and I'm sure by the time we finish this, he'd be changing them again. So I think we really just have to ignore the noise to an extent, take a measured approach, but making ultimate decisions around tariffs at the moment, at Beachbrook anyway, with our portfolio companies, is just staying calm and waiting for everything to play out. But I think ultimately, we really do mean this, is that companies will adapt, whatever the situation will be, and you just have to keep moving forward.
Yeah, I mean, as part of our risk monitoring, obviously we looked at the portfolio and the impact, which is very minimal, but we'd be looking at factors that impact risk. For example, foreign exchange movements, tariffs, all these things. We did have one customer last week where we fund their software, but they also have hardware, and that's manufactured in Vietnam. They're selling into the US market. It's a low margin business in the telco space. Like, that has just set off a bomb at their board table in terms of the go forward. The pause obviously is kind of paralysing, but so, you know, I suppose from our point of view, we fund across all sectors, so we're going to have to dig into, because we're in the underwriting business, you know, how this plays out in terms of how we will stitch that into our underwriting.
Yeah, so it's challenging a lot of boards, and that's where the steering, I guess, of the organisation happens. And having a board and having good steering is really important. Any questions from our audience for the Brains Trust here? Gentleman in the front here. Just give me a show of hands to show me how many questions are out there, by the way.
Yeah, great presentation. Thanks very much. Ian Cahill is my name. I'm curious, at least two of you were formed out of the last adversity of 2008, and so we managed to get this far without mentioning AI in any conversation. But obviously, where do we see the opportunity in the adversity to put some enlightenment in terms of what's happening, in terms of for across the business you might see right now?
Well, we use AI in our own business. I would have to say that we use it. So we have our own in-house technology team, and we obviously have a risk team. We have various different pillars within the business. And AI has supercharged our operational workflows. It has increased productivity. We're also looking at Gen AI in terms of how we can surface that for customers to try and make the complexity of what we do more easily understood. I don't see us maybe using AI to underwrite, but it'll help us use the data that we're ingesting to reach faster decisions, but we'll be the guardian of those decisions.
Yeah, our proudest AI play at the moment is in a company called Capture, where we are solving a big world problem, which is getting a quick pint at half time in a game. And we launched in Norwich 2 weeks ago, where we've got vision cameras in the ceiling. You tap, go through a turnstile, and the vision tech spots that it's you, your card. You take the pint, you walk out. We're putting through 200 pints with queues in this bar, and they put through 350 with no queues and half the staff. So we're Cork will be busy in Croke Park later in the summer. So we're going live in Croke Park, so you'll get to see it.
I think just across our portfolio at an operational level, it's been implemented across various sectors, but from an underwriting perspective, similar thoughts to Helen, I don't think ultimately it will be a deciding factor for us because, as I mentioned earlier, if you are investing in an SME, over a 5-6 year period, it is ultimately backing the owner, the management team. I'm not sure if we're there yet with AI in making that decision for you.
Thanks, great question, Ian. Gentleman in the front here.
Thank you. Jonathan Gray from Ovation Incentives. One of the funding paths that wasn't really talked about today was the public equity markets and their use for funding, particularly small to medium-sized enterprises. When you think of the last few years, the opportunity for sub-100 million turnover businesses to use the public equity markets has significantly declined, and the use of M&A and private exits has flourished. If you take the example of the AIM market in the UK, which was designed to fund such types of businesses, there was 1,500 companies on the AIM market a decade ago. Today, there are about 700. Is it the cost of public finance or public equity financing, the risk of it, or the fear, or the regulation that's driving the exit route for businesses to private equity and M&A rather than to the public markets, particularly for the smaller to medium-sized businesses?
Great question, Jonathan.
Yeah, I think it's. I think if we look at our hero companies in Ireland, we look at the, all around the Kerrys, the CRHs, the Paddy Powers, the DCCs, and all our we all grew up. They were the hero companies, and you can kind of plot the paths, the Ryanairs, the whole lot. You can plot them. I'm pretty convinced those same companies in today's market wouldn't be IPOing. Obviously, Applegreen is probably the most recent success story that has come through it, because there's such a plethora of options. There's such international, we're reporting on it every week in the newsletter. It's just the level of international private equity, and it's just take a Jimmy Martin in AMCS up in Limerick. That business is worth reported to be near 3 billion now, and the tech is on every bin truck in the world, and people don't realize it exists, and Jimmy's founder and still a significant shareholder, but he's got to 3 billion value. Someone's backed it because they think it'll get to 5, 6, 7. That's in your real IPO territory. But why would you show the world everything you're doing and have to report to analysts 3 months when you can do effectively with a handshake get private equity? And look, we're at the smaller enterprise values of 10 to 50 million, but there's such an ecosystem of global players at the biggest level. Pros and cons. What would you want to do at a bigger level? If you can do a handshake and have a relationship with someone who understands your business, it's probably a path of least resistance to do a deal with private equity. And at a lower level, there is, as I said, there's 10 dozen brass plates. There's ourselves, there's BGF, there's MML, there's Cardinal, there's Melior, there's Causeway, there's Foresight. There's such a plethora of options. If there's any gap, I think the bigger gap is on this on the EIS and getting people. The bigger gap is the 1 million funding, because if you're looking for a few $100,000 and you're credible, you'll probably get it from friends and family. If you're looking for 3, 5 plus, there's a lot of brass plates and they're at critical mass to do it. I believe, I don't think they aim they tried. That Swedish stock exchange tried to do something and a couple messed around at it, but it wasn't. I think the bigger gap is at the 1 to 3 million for EIS, where someone can put their money in, get a tax break, and give their experience as well. That's the bigger gap in an equity sense, because I don't think the public markets offer anything that the privates don't offer, really.
Okay, any other thoughts in the panel on that? Helen?
No, actually, Collect refuse tech platform that we used to fund were one of the players that went down that route of raising on the Swedish stock exchange. And from talking to the founders, I'm not saying it was a bad experience, but it does come with its obligations, and that was for a much smaller company. I mean, the question, we're not playing in that space per se, but we observe big players that are going down that route. You have the likes of the Klarnas. I do think Mark's point, though, around that EIS, again, it goes back to the funding gap. And just worth noting that, again, selfishly for any founders or business owners in the audience, there is a slight market failure or challenge at the moment with respect to raising equity in a certain ticket size. We're finding that companies are having to go back to their boards and they're not able to raise equity, and they're going back to existing shareholders asking them to put their hands in their pocket again. And sometimes they'll want to do that and sometimes they won't. And there are mechanisms, one of which we have, where existing shareholders can follow their money, underpin their investment, but do it at arm's length, where it's liquid, it's not subordinated, it doesn't disturb the cap table, and it enjoys the real-time monitoring and oversight that we do day in, day out. So again, that's an I'm sure nobody in the room knew that was an alternative. So it's about educating about how we bridge these gaps.
Yeah. Okay.
Economy and for our nation and for even for Europe to have a vibrant public market structure that does work?
It's a good question, because obviously it's all eyes on the concentration that FDI presents to the economy, and that our scaling middle, which is our addressable market, needs, it's a fair point, but I think the mindset of that cohort they're not in that zone, would be my observation. I don't know what Alan and Mark think.
Yeah, I think it's an unfortunate byproduct if there's less, like all of our heroes, the Dennis Brosnans, the Michael Smurfett, the Stuart Kennys, the Michael O'Leary's, all the, there's less, it's less played out in the public eye, which is unfortunate. But I think that's incumbent on events like this, and we've Jimmy Martin speaking at the Real Deal in Goffs in the end of May to I think we do need role models. The entrepreneurial ecosystem needs role models. It's unfortunate with that. It might be harder to put shares in people's hands, but it's still doable in a private thing. So there are pros and cons, but like if personally, if I was in a business being faced with IPOing at $1 billion value or doing a handshake with someone that Jim Barry can put me in touch with, I'd prefer to do the handshake.
With a lot of due diligence now, if Jim Barry put you in touch with them, to be fair. I'm only joking, Jim, only joking. So great question, Jonathan. There is a question there about how much the public market is really part of democratic society in many ways, and if it doesn't function, does it need to be reformed? And I'm sure Jim will talk later on, as John alluded to, about sustainability and climate. And one of the questions I asked recently was, some of you would have engaged with CSRD. How did it ever get that far? That public companies, for example, and moderately sized companies had a big target on their back that says, you'll just do all of this. Yeah, you'll just do loads of this. Like a version of it could have worked, but maybe not everything that was envisioned for something that is really needed for the climate crisis. So it only remains to me to thank actually Alan and Mark and Helen for their wonderful contribution. I always say that talk is cheap because supply massively exceeds demand, okay? But in this case, in 45 minutes, I think the three here have covered a lot of ground at a very high level and only tapped on the edge of their expertise in this. So there are alternatives available to you now in terms of raw material and funding of your business. And it's a journey that we'll see more and more in the years to come. So thanks to Paul for having the foresight of scheduling this as a topic. And I think Paul is going to speak to you again before the break. No? Well, I think Siobhan actually is. Put your hands together actually for the panels before.
So thank you to everyone, and thank you. That was an excellent panel discussion. Thanks to Helen, Mark, Alan, and Brendan, of course. So now, guys, it's time for some refreshments outside there in the hall, and we'll reconvene back here about 11 o'clock, half an hour. Thanks very much.